Good to see everybody back here again, another year. Want to welcome those of you who traveled here from other places of the country or the world. We actually get a lot of travelers that come in for this conference every single year. And I know it's Westchester, New York, and you may think that Madison Square Garden is the home of the Knicks, but it's actually Westchester for those of you who don't know that. So, let's go Knicks. I want to thank DealFlow for doing this again. This is a very important event for this industry. Doing it every year, talking about a lot of very important topics. And I think we scored with the weather this year. It's phenomenal. So, kudos to that. Going to get just a little bit about me and Loeb. I'm the co-chair of Loeb & Loeb. We've got over 500 lawyers, 9 offices. People call us OGs in the SPAC space. Been doing it for 25 years. And if you go by league tables, number 1 in terms of de-SPAC legal counsel for 25, and 10 years before that, and last year number 2 in IPO legal counsel. I think I got a pretty good track record in evolving all of the ingredients of where SPACs are now structurally in terms of the price, domestication, and so forth. We got a whole bunch of people here this year sitting up in the front row. Okay, so let's look. Here are the list of topics and what we're going to go through today. I'm going to try to give you as much as I can give you in terms of where things are with SPACs right now in 15, 20 minutes, or whatever it is. I'll try to make it shorter than that list of sponsors that Steve just went through. So we're going to talk about a little bit about what's going on in the IPO pipeline, de-SPAC pipeline, what's going on there, current trends, the new ways of SPACs that we've seen over the last 2 years. I think it's important to talk about that and the impact that it's had on the SPAC marketplace. Practical challenges, well, before that, the legal regulatory update, and that's a very, very big thing this year. I want to spend some time talking about that. We've got some significant updates this year, which will impact SPAC significantly, I think, for years to come. So I want to spend some time talking about that. I want to talk about some of the practical challenges in the SPAC market and how I think we're going to deal with that going forward. Funding solutions, managing exchange listings and de-SPACs, which is a very, very big deal for SPACs because this is the primary driver. It's always been the primary driver for targets who want to enter into de-SPACs. So managing through those exchange listings are very, very important. And then I want to talk about where we're going. And then I'm going to reserve some of my thoughts and comments, my opinions to this section. So like I said, I'll try to get there as soon as possible and get to that. I usually like to start these things with giving a little bit of a background and landscape in terms of what's the deal flow look like in the SPAC market now. We have already, by the way, this was June 1st. The IPO number has been updated from 92 to 106 this year. We're up to 106. And so if you look at where that is, look, we're not at the 2020, 2021 bonanza when we're up to 613 SPAC IPOs. That was a very significant number. We actually crossed over 60% of the total IPO market in 21. 613 was a number, that far and away beyond anything we've seen since. We saw that drop off in 22 where it went down, I think, to 86, but some of that was a hot first quarter. So you started seeing the dip into 23. And then you started seeing a buildup in 24, 25, and this year we're on track to be 26. Another number I think it's important to look at there is the percentage of the overall SPAC market. Typically, you'll see the SPAC market be around 40-something% of the total IPO market. That's what we usually have seen. But what you're seeing this year is we're over 60% of the total SPAC percentage, total IPO market. So that's significant. We'll see what happens. There's a lot of new issue coming out in the IPO market now with SpaceX, Anthropic, all that stuff. So that might impact that percentage. But right now is where we are for first half. It's a very, very, very significant part of the total IPO market. So now let's talk about the de-SPAC transactions. So, what you see there is we were up to 153 announced transactions in 22, de-SPAC transactions. Now that was a large number because that was the hangover from the 20 and 21 vintage. But that number continued to go down in the succeeding years. We went down to 114, 69, went all the way down to 27, right? And now you're starting to see that come up. So the de-SPAC numbers haven't fully recovered yet in terms of the announcements and business combinations that we've seen in prior years. But what we are seeing on a day-to-day basis is we're starting to see those announcements, we're starting to see those numbers come up, and much more will probably come. So again, I think we're going to start seeing a lot of announcements in 26. Now, that leads us to the current trend of like the crowded, what, you know, it tends to happen when you have active IPO markets, you get a crowded SPAC market. As of June 1st, 9 days ago, 245 SPACs were searching, 245. They had 147 billion in trust seeking a business combination. And the market's sitting back and seeing, what are these SPACs going to do? 245. Are there enough targets? Are there enough good targets for them? And I think that remains to be seen. Redemption rates, always looking at redemption rates. Actually, this is a pretty encouraging statistic for last year. Redemption rates actually went down to 85%. I know it sounds super high, 85% of the funds are redeeming, but believe it or not, it's gone down from well in the 90s from prior years, down to 85%. So some things are beginning to work again in terms of keeping money in and not redeeming, and we'll talk a little bit more about that. The pipe market, the fundamental pipe market, still not strong. 1.28 billion of pipe financings for de-SPAC transactions in 25. Out of that, like one transaction had the overwhelming majority of it, and that's down for 1.8. What I will tell you, and for whatever it's worth, when we're seeing the announcements of de-SPACs this year, we're really starting to see some committed pipes being announced together with the de-SPAC, and we're seeing that at a clip that's really exceeded what we've seen over the last few years. So I think that's really encouraging. We do have to see what the data is going to show through the balance of the year, so I don't want to get ahead of ourselves, but I do think, you know, we're seeing progress. We're seeing some more committed pipes. That's a really, really good thing for the SPAC market, but again, we'll see what the data says. The other thing to look at in terms of important metrics are the price, what de-SPAC stock performance is following the de-SPAC. And there we've seen an increase as of this month of $4.26 in terms of where de-SPACs are trading now at $4.26. That's better. I mean, it's better compared to $3.54. I know the concern's always like, where is this price going to go after the $10 deal that they're going to do at the time of the de-SPAC? Remember that the $10 represents how much is in cash. So when that is redeemed, then the question is, what's this company worth standing on its own? 426 seems to be where it is right now. I think a lot of that number is really dependent on how deals are being priced, at what value they're being priced, is there pricing discipline, and how the overall market's been doing. And let's be honest, the market has really done well these last few months, given the AI trade and so forth. Again, I think we're starting to see a little bit more decoupling and understanding in the capital markets that you can't really compare the after de-SPAC price with the $10 unit price, that the $10 is really representing the cash and trust, and when that starts leaving, you have to start looking at what the company is valued at on its own. So I think there's starting to be some education in the market on that, but not completely. What we're also seeing is the rights and warrants. You know, there's the composition of units tend to change. When markets are down, you tend to see more rights in the units because there's less confidence that the stock prices will trade above the exercise price in the warrants. But what we're seeing right now is a bit of more of a movement back to warrants, which is showing a little bit more positive momentum or enthusiasm for these deals. We're seeing amounts recycling of capital. That's super important for the SPAC IPO market because as investors put money out, we needed them to get it back to be able to reinvest in new IPOs. This gives you a sense of what we see. 23 liquidations in 25. That's not a bad thing. That means $4 billion have gone back to investors that they can redeploy in new IPOs. Those redemption rates, you know, although we'd love to see them in the deal going forward, that also provided another $6 billion coming back to investors in 25. So they got back $10 billion of their money just through that. A couple years ago, we saw a new wave of SPACs called the syndicated structure. And that was a structure where sponsors could put up as little as $500,000 and the rest of the private capital could be solicited from other outside investors. And we saw, a lot of it really spurred a lot of activity for SPAC IPOs. In all honesty, we're seeing that trade slow down a little bit in a couple ways, in terms of number of syndicated deals and dollars. But what we're seeing is that sponsors are picking up the void and they're stepping up with money. What the benefit are to syndicated investors is that they could average down their investment price from the $10 IPO price. And it has also pushed the market into larger IPOs to get more shares over to investors to be able to lower their price. What we've also seen over the last 2 years, and I'm sorry to break this to the underwriters that like showing up here, I have to say it's true, is that their back-end fees have just been under pressure and have gone down. They've gone down significantly. Many are waived, or they're converted into equity, or they're based on whatever funds are remaining in trust. The largest factor, though, I think, to this new wave of SPACs, as you see these numbers peak up, the largest factor, in my personal opinion, is the challenge to the traditional IPO market, particularly the small cap market, and that's because NASDAQ has imposed a $15 minimum, and a lot of small cap underwriters are challenged with some of these deals being able to consummate comfortably a $15 million IPO. And what that does is increase the level of uncertainty on the completion or success of an IPO through a traditional IPO. That is significant more risk, and so on a relative basis, it has made the de-SPAC more attractive, I think, than in years past. And I think that's a very, very important factor. Let's go to the legal and regulatory update now. So there's a lot here, but I'm going to try to cover it very, very quickly at a very, very high level. The SEC has now proposed rule amendments. This is brand new. It'll take a while. We have to go through a comment period. It could take a year or so forth. But it's been very, very interesting to see what the SEC has been proposing. They're talking about revising S3 eligibility. That's a short form registration statement, could be used as a shelf, and it could be used immediately at the de-SPAC. Previously, you had to wait a year. Now, this is like a very, very important development because, to be very, very honest with you, the current small micro cap type ecosystem, they know how to do RDs, they know how to do shelf offerings, they know how to do those type of deals. They're much more challenged with pipes and stuff like that. So I really think that this development is going to be very, very positive for SPACs. Now, just to technically, people are going to ask, can SPACs use it? In the proposed rule, they define something called a BSP issuer. BSP stands for B is for blank check, S is for shell, P is for penny stock. It specifically says SPACs are accepted from this, which means that they could use S3. And I can't underestimate how I think that important that is, and I'm going to talk about that more, because I really do think that it makes the SPAC, again, a more attractive alternative. Some other proposed rules, I'm going to go through them quickly. I don't want to get too technical here. This is supposed to be a little bit more high level. But they're going to show more flexibility in being able to be eligible for S3. If you miss a filing, you have to be on time with every single filing for a year. And we've seen issuers, particularly small issuers, they miss one filing and boom, it's over. They can't use it. But they're talking about making an allowance to allow one untimely filing not to have a problem. Other things are F3 for foreign international deals. There is no benefit. They won't be able to do it. No surprise with this administration not showing any love to the international community and going with the Americans first. The other thing is WIXI, well-known seasoned issuer. So usually when you're a significant market cap, when you file a registration statement, you're really not looking at much comments going back. It's a fast-track registration. And they are looking to allow smaller companies to get the benefit of this automatic shelf offering 12 months after the de-SPAC, which means that after 12 months, so for the first 12 months they could use the shelf as I just talked about. After 12 months, you could file pretty much as a WIXI does right now, which means we probably won't get comments. What all this means in terms of the S3 using S3, and after 12 months filing as an automatic filer, it all really means it's a quicker financing cycle for de-SPACs, more access to capital, and less work for the lawyers. Now, I think that's about everything you wanted to hear for today. All right, so look, there's some other benefits in terms of the legal benefits. I don't want to get into all of it. They're extending disclosure timelines, making it easier for more small public companies to extend the dates for periodic reports. We're simplifying the public reporting system. All of these things, but there's some very significant practical impacts, and this is a very welcome development. I have to admit that this is the first time in a very long time that the SEC, our government, has taken action to make capital accessible to smaller companies or friendlier to smaller companies. This shows a demonstrable move from the Gary Gensler, Elizabeth Warren regime. And if those of you have those dark memories from that regime, I certainly do. I mean, they made it very difficult to us. I mean, this is a significant move away. That regime went on record calling our space, our small cap, micro cap space, SPAC space, they called it a swampland. And they viewed it as a danger, as a risk to investors. And they treated the space this way. So instead, you know, there's another way to look at our space, which we hoped our regulators would, and I think maybe this is the beginning of that, which is it's a gateway to innovation. It's a gateway to jobs and opportunity, and not all of these deals will work out. Many of them don't, we all know that, but some of them do, and those benefits are invaluable. So look, while we've been critical of the actions of the SEC at this conference and our government over the last several years, particularly 4 years ago when they came out with their proposed 2022 rules that were completely targeted against SPACs, we have to be very fair that this development is very, very beneficial to this space and is a very, very significant development. But NASDAQ, on the other hand, is a different situation. They've imposed an IM 51013 protocol in December, which makes it very, very difficult for international companies, particularly those out of China and Hong Kong, and they're using a lot of discretion on accepting those listings. So it's not just quantitative in terms of meeting the quantitative requirements, they're actually showing a lot of discretion and making it all about a qualitative decision. That leaves a lot of uncertainty for those deals. They're also scrutinizing the shareholder composition, the round lot shareholder composition. They're really looking at how these shareholders came into the stock and scrutinizing whether that's been done appropriately. They've also increased the actual dollar value of market value of listed securities numbers from 50 million to 75 million for capital markets and from 75 to 100 million for global markets. So they've made it a little bit tighter. They want larger SPACs to be able to accept those. So let's talk about some practical challenges to the SPAC market. Look, we've talked about the syndicated deals and sponsors trying to spread out risk to others. That trend has slowed, but we haven't seen it slow the SPAC market because investors are stepping up. Cayman continues to be the norm. Nobody wants to start dealing with paying the tax in the US when you have a Delaware SPAC, the excise tax, so pretty much all SPACs are in Cayman. And then there's the redemptions and the limited SPAC market. So we've seen, as I've demonstrated, the redemption rates over 80%, 85%, and we're dealing with a limited fundamental pipe market. And this is very, very important because if you look at why companies want to merge with SPACs, SPACs present a very important role, which is they provide clarity and certainty that the merger will happen, that the listing will happen, that they will go public. But what it hasn't done up to now is provide clarity and certainty that the funds will be there when you've got high redemptions and a limited fundamental pipe market, although there is an active structured market. But that structured market presents issues with regard to price performance. Okay, so I'm trying to get through this part a little bit quickly. Extensions are still very rampant across the SPAC market as they run out of time. You see them You see SPACs putting money into trust to keep these deals moving forward beyond their expiration dates. We still see equity lines and convertible debt deals to try to get financing into these SPACs when there's high redemption rates and limited pipe market. But those aren't the best thing for price performance. Having an S3 available with different terms coming into that financing, I think, is a great development, again, for price stability. Non-redemption agreements and forward purchase agreements are still around, and they basically allow SPACs to meet the public float requirements and market value of listed securities tests of NASDAQ. So they're still an important feature, but you have to deal with the cost of that. Let's talk briefly about exchange listings for de-SPACs. You got to be careful when you look at SPACs that have extended, because when they've extended, they've had a lot of redemptions, and then we have to start looking at how many shareholders are left, and we have to start thinking about how to build that shareholder base. And as I said, the exchanges scrutinize that. So that's still an issue that we need to manage for de-SPACs. NASDAQ, NYSE people ask, which one should I list on? I don't know, they're both good. But you've got to deal with the protocol that we're dealing with now with NASDAQ. They present benefits and disadvantages. That's a longer conversation. And then also you need to be aware of the new NASDAQ suspension policy, which means that when public floats go below certain numbers, like 1.1 million for global or 500,000 for capital, they can, out of public policy purposes, just suspend the trading of the stock. So it's very, very important to look out for that. It's also important to look at the fact that there's a 3-year limit to complete a business combination under the exchanges. Although I will say that we've seen a lot of progress with the exchanges in terms of letting these SPACs delist if they run out of time, and then accepting them back because they were always a SPAC, and once a SPAC, you're always a SPAC. We had to run through a lot of gymnastics to try to come up with different structures to get them back, but the exchanges on this front have, their changes are helpful and more welcome. All right, so now we're up to the end of where we're going from here. SPAC IPO numbers will increase, and they have increased over the last couple of years as those funds have recycled. But we can't expect to start getting to a number of 600 like we did in 21. I don't think that was helpful or constructive. But we're on a run rate of getting to over 200 SPACs, and we'll see if that's the right place to be. SPACs are going to continue to have their place. They're a much-needed solution for many growing companies that are underserved by the traditional IPO, private equity, and venture capital. And you could start seeing that in the first half of this year. I've said this many times before, because I seem to be speaking in this role every single year, that SPACs are the answer to the problems and the challenges with small cap IPOs and niche IPOs. The niche IPOs, the ones that don't fit into the hottest sector that the big banks are taking out at that given day. They're really the only capital market solution left for those type of companies. With the 15 million small cap IPO being the standard, it's become very difficult, or too difficult and challenging and uncertain for the companies to go public through small cap IPOs. You're seeing less and less of that. 20 years ago, we saw a lot of reverse mergers. We saw these companies merging into OTC shells and then elevating to the exchange. But NASDAQ and the exchanges and the SEC pretty much shut that down in 2011 when they made these companies season and stay on the OTC until they season. So we saw that sort of, for the most part, go away. Not completely, but for the most part. And then, yeah, you do see some reverse mergers with NYSE or NASDAQ shells right now, but the supply of those shells are really, really small. They're very limited, and because of that supply, even if you can get one, it's going to cost you a fortune. And even if you get through all of that and you find it and you spend that money for a listed shell, all the brain damage and risk associated with cleaning up these shells because of the businesses that they've had before them can't be underestimated. So SPACs have really become the viable alternative for smaller cap companies that want to go public. But as I said before, with high redemption rates and a limited fundamental pipe market, And I don't mean structured pipes, and I don't mean pipes that they have a relationship with or a strategic connection to, but your typical marketing of a fundamental pipe or trying to market redemption rights to be low. Financing for SPACs have, to be honest, been unclear and uncertain, and it's been this way for years. The new SPAC proposal, and the reason why I'm so hopeful with this new SPAC proposal, is that it gives the de-SPAC market much more clarity, access, and speed to financing, which might be the solution we were all waiting and hoping for. And that, I think, is good news and may provide us a path forward, or at the very least, has provided me with an opportunity to kick off this conference on a positive note and hope that you guys can carry this through to tomorrow night, at which case we'll be up to Game 4. Go Knicks. Have a great conference. Thank you.